Piper Sandler chief investment strategist Michael Kantrowitz joins us now. So no upturn, does it stay flat, does it downturn? What do you think are some of the key issues at play here for earnings?
Yeah, I think there's a lot of debate around, are we heading into a recession or not? Are we in a recession or not? And I think there's equal reason to look at the other side of the story and say, well, are we in a recovery or not? And I think right now, neither of those situations are quite apparent. And I think that's why we've seen the market really reward the higher quality, larger cap, more visible, better balance sheet companies this year, and why you've seen this bifurcation. And I think that'll continue in the market until we kind of really clearly have a soft landing, which is, a broad-based recovery in the economy, or enter into a recession, which is usually signaled by rising unemployment.
So you've got this stay big call for 2023, and the bifurcation you're referring to has to do with that between the largest stocks and some of the smallest stocks. But how are you thinking about things in terms of valuations? Because especially, the Magnificent Seven have come down a little bit, but a lot of people are still looking at that as the key driver for this year's broader index performance. So are you concerned that maybe it would be the wrong time to be getting into these bigger companies that have been such a key driver of market activity this year?
Yeah, I think this year, the market's up, and the indices are up, and especially those stocks are up a lot for two reasons. Their earnings have been pretty good, and we've seen a big amount of multiple expansion this year from last year's downturn in equities. So the way I look at that is that we priced out a lot of risk, around inflation, around the Fed doing too much, and so we've kind of removed a lot of those risks, and the companies that maintain earnings momentum are still doing well. So with regards to valuation, I think that's what that reflects. What I'd be concerned about is not necessarily the valuation levels of these stocks or any stock individually, but trying to understand what drives these valuations and where those drivers are going. So, are we, we've seen the soft landing hope a number of times this year, pick up risk assets. And when that's played out, you've seen credit spreads tighten and a lot of cyclical stocks do well. And then the last, for example, 6 weeks, they've kind of given a lot of that momentum back. So I'm more concerned about the drivers of valuation and investors pricing in and out of risk. And I think we're going to, again, continue to see this back and forth.
How would you characterize the current risk environment right now? I think it was Morgan Stanley that characterized it as fragile, and Bank of America pointing to the tremendous amount of outflows and on pace for one of the worst weeks we've seen in months this year. So how would you characterize just the overall sentiment in the market right now?
I think it's very uncertain, and I think that's why we're seeing the narratives shift really quickly back and forth, which is most evident in the most cyclical parts of the market. When I look at the through our lens, we see a lot of asymmetric downside risks in the economy. And that's where our conviction lies, is that the odds of getting any kind of broad-based recovery, which would provide you that sustained broad-based market, especially led by the more riskier small cap value parts of the market, the odds of that are extremely low, with the tightening cycle, oil prices rising, banks tightening lending standards. And that's kind of how I see it.